Hi, this week we're going to focus on financial analysis from a high-level business owner's perspective and not from an accountant's perspective. I recommend accounting courses to learn how accounting is done so that you can better understand your financials and tax implications. We'll discuss 4 topics: financial statement analysis, sales forecasting, estimating costs, and cash flow projections. Our main purpose will be estimating net income and cash flows so that we know how much and when funding will be needed to launch the business or fund expansion. Let's start by defining financial analysis. It is the process of examining a business's financial statements to assess its performance and ability to service debt or return investors' capital with earnings. The primary objective is to assess risk and financial rewards for assuming that risk. Now that we know what it is, how is it used? The 3 main ways financial analysis is used is for investment decisions, business strategy, budgeting, and planning. For investment decisions, investors are going to evaluate the profitability and cash flows to determine if it meets short-term and long-term goals. There are going to be both internal and external users. Internal users are the business owners or executives, and the external users are outside investors and lending institutions. When we're talking about business strategy, this is where business owners and executives are making critical business decisions based on financial data. It identifies profitability and risk drivers. An example of a business strategy decision would be launching a new business or new products or service offerings. And this is done by internal users. In budgeting and planning, the business owners and executives are allocating resources and planning for future operations. An example of this is determining funds available for capital improvements or hiring new employees. Again, this is done by internal users. Financial analysis takes the numbers and tells the business story about the business's decisions and outcomes. It tells the reader what the business priorities are, and those business priorities could be growth or investment returns. If we're talking about growth, that means that the business is retaining cash or net income within the business to fund long-term business opportunities. But if the business is prioritizing investment returns, they're paying cash out to the investors and minimizing expenses in order to maximize those short-term investor gains. It also reveals how efficiently the business is utilizing its assets and how productive it is in generating cash and profits. So we're looking at asset utilization rates. It also sets the priorities and addresses what and how business decisions will be made. Good financial analysis means you're being proactive and not reactive. Proactive means that you're budgeting, analyzing data and trends as they're happening so that you can influence the outcome. Reactive means you're just analyzing past performance, but it's too late to change the outcome. Proactivity starts by establishing a budget by projecting sales and expenses to achieve desired cash flows and profits. Sometimes it means reducing spending or increasing sales to stay within budget. Budgeted numbers become our benchmarks so that we can evaluate progress towards a goal. We also need current accounting records. Ideally, this means having reconciled numbers on a quarterly basis, which means every 3 months. Not looking at current financial statements and budgets turns this whole endeavor into a reactive analysis, which is not the goal. Then we need to compare actual to budget, and this becomes our variance. A positive variance occurs when revenue exceeds budgeted amounts or expenses are lower than the budget. A negative variance occurs when revenue is below budget or expenses exceed the budgeted amount. Just knowing that the variance exists is not the whole story. We need to explain the variance. This may be as simple as repairs were higher than budgeted because we had unexpected equipment failures. These explanations are then used to make our next strategic move in either the current period or we're looking to improve our budgeting process for the next year. If we see a repeated pattern that we're always exceeding budgeted repairs, then we either need to do a cost-benefit analysis on replacing that equipment or increase our budgeted repairs amount. If we increase the budgeted repair amount, then something else will have to change in order to maintain profitability or cash flow requirements. Financial analysis doesn't just end with explaining these variances and creating a story. It's about connecting the dots between the numbers and business actions that are or can be taken and strategizing how we can affect the outcome. Businesses have great plans and expectations, but they won't come true without strong financial planning and analysis.